Welcome to Dig Deep, the mining podcast. In this podcast, we go deep into mining news, hot topics, and live interviews with mining professionals and leading figures in the mining industry. Introducing your host, Rob Tyson, founder and director of Mining International and Mining International Executive, a leading global mining recruitment and headhunting agency.
Hi, mining community. Welcome back to another episode of the Dig Deep, the mining podcast, the show that brings you the latest insights, thought leadership, and stories from across the global mining industry. In today's episode, I'm joined by one of the industry's most respected leaders, Mark Cutifani, the former CEO of Anglo and the chair of the ICMM. We're going to be discussing the long-term supply outlook for mining, the risks, opportunities, disruptions shaping the next decade, from critical minerals to geopolitical shifts to innovation and resilience. Mark's going to share his perspective on what's coming up and how the industry can obviously prepare. Mark's also going to be attending the upcoming Resourcing Tomorrow event, the premier gathering of the world's mining leaders taking place in London from the 2nd to the 4th of December. What sets this event apart is the unmatched audience. You've got C-level executives from some of the biggest mining companies worldwide, over 40 government ministers, leading mining technology providers, and many more from the mining industry. Dig Deep, the mining podcast, is a proud sponsor with the Resourcing Tomorrow event, and there's going to be some discounts if you register through us to attend the show. So all the details are in the show notes in terms of getting tickets and getting some discounts. So please take advantage of the great opportunity, and hopefully we will see you there. Mark, welcome back to the podcast. How are you doing?
Thanks, Rob. All good.
Good to hear. As we were obviously just speaking offline, and I imagine that our audience will want to know, what have you actually been up to more recently? Obviously, you left Vale more recently, and obviously Anglo before then. So what has Mark actually been up to more recently?
Well, since retiring from Anglo, I've been involved firstly with Vale Base Metals and helping them reset their base metals business up and build a new team there, and Sean Usmar and the team are doing a great job. And also looking at other assets around the industry. I'm a member of the Odin partnership, a partnership between Tony O'Neill and a former banker, Omar Davis. So we've got our fingers in a lot of pies. Or participation in things that people might be aware of is the Global Tailings Management Institute. So the establishment of the group that will oversee the implementation of the new standard set for tailings across the industry, with ICMM, ethical investors and the UN involved as partners. And that's been really interesting. I have been involved in some safety work, more particularly the investigation on the El Teniente fatality a few months back, where we lost 7 miners. And also a number of other things that are bubbling around the traps on mining industry stuff, new opportunities. So quite an eclectic mix of involvement. It's been interesting.
Yeah. So been keeping yourself busy, which is
Always,
good to hear.
always. My wife doesn't want me at home.
Yeah. You've spoken about geopolitics and obviously tariffs as a major supply chain headwind. Looking ahead for the next, say, 10 or 15 years, how do you see the strategic geography of mining changing? For instance, could we see a new safe supply corridor or partnerships emerge? And how should companies position now to capture those?
Well, first thing I would say is one thing that I think has been evident to most as the geopolitics have become more complex and we've had splits and people have threatened, we're not going to supply you with this and we're not going to supply you with that. It's pretty clear that no one country dominates global minerals and metals supply. And for the world to function and for individual countries to function effectively, we're going to need to trade. And by trade, I mean trading across geopolitical blocks on a global basis. And you're seeing that in the way the conversations are starting to come together between the US and China. So I would expect a continuing, I'll use the word fracture, but not necessarily in a negative sense, where you'll have multipolar uh, shifts or multipolar centres of interest, where the Saudis will be very important with what they're doing. The US will continue to be a major player. China will be a major player. Europe will be a much stronger centre as it gets its head around what it requires. Africa will become an important source of materials. So I think people are starting to work out that we need to work together to supply materials. And so I'm quite optimistic about where the world's going, albeit I think the road's going to be quite bumpy, and we'll need to sort out where we go. But players like Saudi Arabia, Indonesia becoming a little more forward in the way it's managing its materials. I think the world's changing, and it'll be different, but I don't think it'll necessarily be more difficult insofar as preventing supply. I think we'll balance out okay, but it does need all the players to connect, to talk, and to find solutions, and it's in all of our interest to do that.
Yeah, you just mentioned players connecting and I suppose building relationships. Would you say it's more difficult now than it has been for the previous 5 or 10 years?
Um, it has been a little bit in terms of, and let me use the US-China issue, where there has been real sensitivities from a security point of view, and in Australia, you had a period where the relationship between Australia and China was difficult, but I think that's on the mend. I think there was a real tough period there between the US and China. I think both sides are now working out that they need each other in so many different areas that that's getting a little easier. I think some people were probably overreading the play and trying to pick sides, where I think that's quite dangerous. In the end, we need each other, and how you work to be a positive force in that process, I think, will stand you in better stead longer term. So I think I wouldn't call it any more complex than it's been in the past. It's just different. So every big shift changes the nature of how you've got to do things, and how you navigate those shifts is where the complexity is. But once you're there, you've still got to manage the complexity of the relationships themselves. So I think it's changing. Other than, wouldn't say it's better or worse. We've got a lot of history in the world, and we've had these moments many times over. So I just think it's shifting.
Yeah. One of your recent themes is the idea of shared value in mining. When it comes to critical minerals for the energy transition, what risks arise if the value chain remains concentrated, whether that's one country or region? And how can mining companies build more resilience, diversified supply networks, but also deliver on social license?
So on the supply side, I think it's always smart for companies to have a diversified range of customers where they can. And in doing that, I also think in mining, it's smart to have certain long-term or commitments that are more long-term in nature to cover your base production level. One thing I think that many mining companies miss is their ability to flex production depending on demand and prices, and there's a real value opportunity there. And for that flex production, if you keep that uncommitted, you can usually take advantage of higher prices. And without going into the opportunities around understanding geology and your ability to flex production and your ability to leverage prices through price cycles, I think it's important to have your base production covered, good relationships with customers that are reliable, and it goes both ways, and then having ability to take advantage of price spikes when and do they, or when they occur. And so I think you've got to be quite flexible in your thinking, and I think that goes with the change. You've got to be able to flex with the change that you see in the marketplace, and not many companies do that terribly well.
In the context of long-term supply, how big a threat is the exploration gap? i.e. obviously insufficient new discoveries compared to more familiar risks like inflation, regulatory burden. In your view, what are the underappreciated levers for mitigating that gap? And I suppose we can look at different regions and maybe places like, for instance, like South Africa.
So, firstly, I think generally, when we talk about the exploration gap, it's more about the exploration gap for deposits that can be developed. I actually don't think we have a major issue in identifying potential sources of materials. We've got lots of resources. We just don't have enough reserves. And by that I mean, in copper, for example, there's lots of copper that's been identified, but getting that copper to market because of permitting and other challenges, we've got a problem with supply, not because of exploration, but because of the processes to get those materials to market. So I think the bigger risk is one of permitting, achieving or holding our social license to operate. So when I go back to shared value, I think shared value is one key way to unlock those deposits that haven't been developed. And if you think about the internet in the last 20 or 30 years, probably 30 years, and people's access to information and seeing how other people live, everybody wants a slice of that life that we can't have here for whatever reasons. And so everybody's looking to share in that prosperity, which means starting from minerals, how do we make sure that those who are most impacted by our development feel as though they've got a reasonable share of the value of the ground that they can see, touch and feel, all the way through to delivering to customers so that they've got a reasonable deal and it's affordable for the customers around the world to want that product. So how value is shared through society, I think is a real challenge. The market has been probably the best way of working out how to share that value, but gee, it's got lots of gaps in it, and there's unfairness for different reasons, and infrastructure is developed in the wrong place. So how do you as an operator balance that equation so that your business is sustainable from all of your key participants' perspective? And I think that's the real challenge for leaders today.
Many mining companies talk about being low cost and at bottom half of the cost curve to hedge against uncertainty. I suppose beyond cost, what are the structural capabilities or resilience assets? And you've mentioned obviously flexibility, supply chain, visibility, stakeholder partnerships that you believe will determine whether a company wins or loses in the next cycle.
Yeah, so I actually touched on it a little bit earlier, but I'll pick up your first point. If what the research shows, and this is what I've seen in the various companies I've been involved in, and the range of commodities I've worked in, and I've worked in most, if you can operate in the bottom half of the cost curve, and I'm talking about the cash operating cost curve after taking into account normal capital development, then you can usually perform through the cycle and generate cash through the cycle. And if you can do that, it generally helps you maintain a focus on creating the most value through the cycle, because you're not making short-term decisions to cover a weakness in cash flow. And that's really important, because the short-term decisions people make on deposits are usually value destructive if they're not able to pay their debts as and when they fall due. So that's really important. And for me, in making a decision to join companies, I've always been cognizant of the view that that asset be managed through the cycle depending on the market, and that's been an important consideration for me, and it's turned out generally to be a pretty good rule. Now, second point is, if you can do that, there's an inherent flexibility in the ore body. So grades are different, or they've got different characteristics that can be viewed at different price cycles in the market, so that when prices are high, if you're able to flex your business and push more volume out to satisfy the market, and then manage with a lower volume but with a lower cost base when the prices are low, your ability to average a price 10 to 15 to 20% above the average price through the cycle puts you, in my experience, the top quartile performers in the industry. So the ability to be inherently flexible around the nature of the ore body, your mining strategies, and the markets you service is a recipe to outperform the market. And what I've said there is a lot in terms of how you think about structuring your business and the markets you play in, but it's the key to outperforming your competitors in the market. And it's one that's not well understood and certainly not practiced broadly across the industry. And then ultimately that point about, do you have long-term customers? They're the guys you can rely on, the men or women you can rely on through the cycle. And where are the other opportunities that you can take when the prices are high? Having that sort of strategy, and it's almost a three-dimensional strategy, is a real advantage. And that's where the really successful players over the long term seem to do better than most.
You mentioned it's not well understood. Is that because there's too many variables? Is that because you're relying on certain things to happen within the economy? What are some of the reasons why I suppose more people are not getting it?
So it is complex, first point. Many people in leadership roles that take on the leadership roles have probably got skills and maybe professional development skills that cover one or two areas across the business. Whereas if you've had a broader exposure and you've probably got the broader experience, I think it's easier for you to just see, you look at the ore body and you can think through the processes and the markets and then ultimately pricing. You can see those opportunities emerge from time to time that many people won't see. And again, if you looked at the business models for the top five miners on the globe, and I've talked about this before, BHP very strongly focused on mining up to concentrate, and it tended not to go into the market because they felt they made their best returns on the front end of the mining process. And generally they've done pretty well, but struggled more in the metal side. So they've been very strong in the bulks. Rio, fairly similar. However, Rio was tended to go downstream a bit more and tended to try and pick commodities a bit more in time. You see that with their recent lithium play. Glencore, trading company. So very openly happy to pay for a lower quality asset on the basis they can make a turn when prices are high. But the markets are changing, so their model's changing as well. Vale, logistics company, probably the best mining logistics company in the world. And at Anglo American, we talked about mining the value chain. So we were quite happy to operate in a De Beers where it's about pricing of your product. So we'd put a lot of effort into that, sort of changed a bit in the last few years. Precious metals, same, a different skill set. And then in the bulks, we played a different game. We were more like a BHP in the bulks. So we're a bit more flexible. And in the last 9 years, we outperformed our nearest rival by about 30% on our returns to investors. And I think our flexibility across the value chain and in the markets we service, that was part of the key to our outperforming our major rivals.
The trend towards decarbonisation, electrification and critical minerals demand is obviously well publicised. But what is the flip side? What supply shocks or bottlenecks do you see emerging for mining networks over the next decade that the market is not necessarily even paying too much attention to?
Firstly, I think all materials are critical. It depends on the supply-demand balance at any particular time. And obviously the energy transition has really pushed the demand dynamics in certain metals, but it does float around a bit. And as I said to someone the other day, I was presenting in Australia, I said the most critical metal in the energy transition is actually steel, because most of the infrastructure of the new, whether it's solar, wind, and other energy sources require steel as part of the infrastructure. So iron ore remains a pretty good performer in that market. I think the big challenge going forward is something people aren't seeing. And I had a conversation with Jeff Immelt back in 2011, who was the chief executive of General Electric, and he asked me a question. And this was when I was at Anglo Gold. And he said, what should I be thinking about as General Electric, making all these products, high quality alloys, special alloys for turbines, all these sorts of things? He said, what should I be worried about in relation to your industry in the next 10 to 20 years? And I said, in the next 10 to 20 years, your biggest issue is whether you can get supply. And I explained to him that mines are getting deeper. Our exploration has slowed up. But I said, the big issue is we can't get projects approved. So getting supply of the materials you need, particularly in special alloys and areas where these things aren't that common, will be the biggest challenge. And that's where we are today in terms of critical minerals. And I think the fact we still can't get approvals through, and in many cases it takes more than 20 years from discovery to development, and this is across the developed world, to get this product out is the big challenge. And as mines go deeper, they become less reliable, or the technologies required to be successful and productive are becoming more challenging. And I don't think people understand the challenge of depth, or firstly, exploration is getting harder. Secondly, the ability to develop is getting tougher and tougher. And then third, the physical characteristics of the operations we're operating, because we're averaging our depths down 40 to 50 metres a year, is becoming much more challenging. So we're heading for some very tough times in terms of our ability to supply to certain demand requirements across the market.
And I suppose following on from that, are the end users really getting to understand the complexity and challenges that mining faces? Obviously, you see some of the car manufacturers, even though they probably want to distance themselves from mining, they are slowly getting involved. I wonder what your take is on the end users actually getting more involved with mining and understanding what mining is all about, and the complexity of actually discovery through to actually getting the supply.
So you're going to laugh at this, but in 2012, a colleague of mine, Peter Bryant, and I established the Development Partner Institute because we saw this issue coming. And we were saying to many users of the products, particularly the automobile sector, that if you want access to the materials you need in those vehicles, and this is before the energy transition, I said we were suggesting they do longer term supply deals with mining companies, because materials will become harder, particularly as the new technologies are introduced. And some of them started but could never quite get their head around this mining industry and the fact that market prices, and they said, well, we're sort of better off getting it off the LME, and they weren't comfortable. But I think that's changed today. And we've seen Elon Musk, they're commissioning some stuff at the moment in partnership with mining companies. He's talked about, if I can't get copper, I'm going to have to change my technology, or I'm going to thrift, I'm going to change the technology, I'm going to use some other materials. I think all of those things will occur and will increase the complexity of what we're seeing. And I think the material science groups, Umicore, Johnson Matthey, these people will become more and more busy working out how to make trade-offs in the technologies, because they're going to be short certain materials. And I think that's going to be a big issue in the next 5 to 10 years.
As mining companies increasingly rely on digital systems, obviously AI, automation, remote operations, etc., to drive resilience and efficiency, what do you see as the cyber supply chain risk for long-term mineral supply? And how should the industry build digital resilience alongside physical resilience?
So we're already seeing cyber disruptions in a whole range of industries. So duplicate systems, parallel systems, systems that aren't accessible out from external environments. There are going to have to be a whole range of protective measures taken within the operating systems. And I know at Anglo, when we were there, we were looking at a whole range of arrangements. So those type of firewalls and protection from the external environment and the disciplines around, let's say, the personal computers that people use in bringing those things into the system will all change, and we all come a lot more a lot tougher in terms of the regimes you introduce. And you're also going to have a plan B and a plan C and a plan D, which may involve no operating systems per se, where some of the work has to be done manually. So having backups or backups that can be readily implemented without too much fuss is going to become the key. And I think that's a big piece of work required, particularly with foreign actors and this geopolitical competition and intelligence in the workplace, which I think becomes a bigger issue as well. So it's one that we're going to have to watch over the next 5 to 10 years as well, again, as the workplace and the geopolitics change as well. And you're seeing that in the chips, in the competition for chips and the debates between the US and China as we speak today.
You've emphasised partnerships with host country collaboration from a long-term supply perspective. How do you balance the need for secure, predictable production with the rising pressure for local value creation, community expectations and ESG demands? And what trade-offs are you seeing in practice?
So understanding your value chains and thinking in terms of the whole value chain, I think is absolutely key. So when we defined the business model for Anglo, and again, it's changed, the guys have sort of changed it since I've gone, but my the way I talked about it is you look right across the value chain, and in the business model Anglo was developing was to be a miner across the value chain. Each commodity makes different margins at different points in the value chain, depending on the capacity and the technologies that competitors have in their market. So understanding that three-dimensional market perspective helps you understand where to put your capital and get the best margin. If I go back to the resource, understanding the geology, the potential resource, the nature of the geology allows you to see value opportunities that many people don't see, and that I thought was a competitive advantage. But immediately adjacent to the geology, you've got a local community. The local community has to put up with a hole in the ground, and it doesn't matter how much as an engineer I see beauty in a hole of a hole in the ground that's been engineered well. The local community generally don't share my perspective, and so how do you make sure that whatever you do is seen as value accretive to those local communities? And I think Quellaveco was a great case study in how that was done in Peru, where we had all sorts of challenges through COVID. The local community supported us through that period, and we delivered on time, on budget, and I think that was very much to do with the local community. So that local community participation was achieved because we were also addressing 26 different projects that community believed was absolutely key for them to be able to support the mine development. And so working your way down the value chain right the way through to customers and those that use your products is something that I think we have to do a lot more of, and we have to think right across the value chain. And I don't think that's a strength in the industry. And in fact, many of the business models in the industry have actually confined people's thinking, and hence there's been a lot of value leakage across the value chain. That's why I said the Anglo business model that we created, I thought was quite different at the time.
If you were advising an upstream mining company today on how to make its supply chain strategy sort of future-proof, what 3 specific moves would you insist they make now, obviously rather than later, and why?
3 key points. Okay, first thing, is identify your markets and where the potential is. And if you see specific risks that may threaten your continuity and pricing, then address that as a matter of priority, particularly while you've got high capital risk. And by that I mean, when you first develop and you need to deliver a return, try and pay your capital back within 3 to 5 years. Somebody used to talk to me about the DRC, and they'd tell me they'd add 3% on their discount rate to factor in the DRC, and I said that's the wrong way to think about it. I said, and I'm using the DRC to be fair, they're progressing, but in the DRC, I said if you've agreed the development of a project and you've got confidence that the political regime will remain in place for 3 to 4 years, you need to get a payback within 3 years, because everything's at risk and the policy framework may flip. And if it does, you're in big trouble. So firstly, your return needs to be 33%. Forget this 12% plus 3%. That's ridiculous. Think about the fundamentals and get that right. So understand that, and also secure your markets and as much as you can pricing to secure the development of the project. Once you've paid back your capital, then you can be more flexible and take a bit more risk on in terms of pricing and doing much better. So that's the first point, is secure the development with the local communities and in terms of where you're selling your products. I think secondly, technical risk remains significant. And again, I would always say invest in the right expertise up front. And again, we had about 3 goes at making sure we got the plans for Quellaveco right. And that money was well spent. Probably took us 12 months longer to get it all set up the right way. But once we pressed the button, and Tom McCulley and Tony Anique and Duncan, who was the head of copper at the time, they were all working as a team to make sure we executed with precision, and that's absolutely key. You can't afford for a project to drag on, and so your execution strategy, having again managed all your partners, the local community, the regional government, the government, they've all got to be locked in pretty well. And then finally, it's about people. Making sure you've got the right people, the talent, the capabilities to be successful is the key to making all of that work. And so for me, it's that pre-planning, setting the project up, quick return, cover your capital, execution in the detail, make sure the project's effective and are delivering on schedule. And 3, making sure you've got the right people at each phase of that development.
And lastly, you're going to be attending the upcoming Resourcing Tomorrow event in London. I just wonder if you can just tell us a little bit about the conversations and talks that you're going to be having as one of the guest speakers.
Again, if you talk about many of the issues you've raised, Rob, they are topical. Local communities and how you connect with local communities. Again, in Peru, things were really tough to get projects away, whereas at Quellaveco, I think we set a model, and I think it was the first major development in the Andes that hit its budget on time and on schedule. So that work's really important. I think people are interested in stuff we've been doing with asset reviews and showing different ways of extracting value. I think that'll get a lot of airplay. And again, how do people practically handle the geopolitical complexities, relationships, and how do you try and position your country? And I think that'll be part of the conversation, and will be next year at a few of the sessions as well, is if you look in Africa, how do you help developing countries think about their resource base and without trying to go too far downstream? You asked this question about upstream developers. It's a real danger for people that have got upstream assets to try and develop fully downstream without building the primary asset, taking advantage of the infrastructure that comes with the primary asset, being roads, power, water, education, health, and all those facilities. Because if you then overcapitalise going downstream, you may destroy the whole project. So you make your money, and then as the country's able to develop the competitiveness of its infrastructure, in particular energy, they can then go downstream where you've got much more energy-intensive processes that have to be competitive to build a more competitive society. But it has to be done in stages, is my experience. And at the moment, I think people want everything tomorrow, and in the end, they get nothing. And I think that conversation and how you pull apart those value points or the value chains and how do you rationally invest to build an industry and help build a country is going to be a really important conversation for many countries over the next few years.
Yeah. Mark, really appreciate your time again. Thank you for sharing your knowledge, your wisdom, your thoughts. And it's certainly a challenging 5, 10, 15, 20 years beyond in the mining industry. And I appreciate you sharing your thoughts. And hopefully those that are listening take some of these on board. Sorry?
As they say, you wouldn't be dead for quids.
No. But thank you again, and we'll see you in a few weeks' time.
Thanks, Rob. All the best.
Thank you. Thanks for listening. Hope you enjoyed that episode. As always, Mark's got a lot of knowledge and a lot of wisdom. A lot of things to take away, and hope you enjoyed the episode. As always, appreciate if you can keep sharing these episodes far and wide. We want to educate the mining industry, and we want to try and give this information and access to everyone around the world that is involved in the mining industry, because they need to develop skills and knowledge in other areas than they're currently working in. So thank you again for listening, and until next time, happy mining.
Thank you for listening. Remember to reach out to Rob via the show notes, and be sure to subscribe and leave a review. Until next time, happy mining, helping each other to improve the mining industry.